Imagine for a second that you've been tasked with doubling the passenger capacity in a high-speed transit system.
Okay.
But the catch is you are legally barred from making the physical trains any larger, right? And you absolutely cannot lay down a single inch of new track.
Oh, wow. That sounds basically impossible.
Right. You just have to somehow force double the volume through the exact same physical footprint. And that impossible physics problem is, well, it's basically what is keeping the most powerful technology executives on Earth awake at night right now.
Yeah, because we always think of the digital world as having this, infinite, boundless horizon.
Exactly. But the reality is it's violently colliding with the uncompromising limits of the physical world.
The bottleneck isn't our imagination anymore. It's not our software architecture. The bottleneck is the actual physical manufacturing capability required to manifest those digital ideas into actual silicon.
Which brings us to our focus for this deep dive. We are looking at the company that is essentially holding the keys to that exact bottleneck, which is ASML.
Right, the lithography giant.
Yeah, they build the immensely complex machines that print the microchips, powering, everything from the phone in your hand to those multi-billion-dollar AI data centers being constructed as we speak.
And we've got some really great source material for this today.
We do. We're pulling our insights directly from a highly detailed earnings Q&A session. And during this call, financial analysts were aggressively grilling ASML executives about their roadmap for 2026, 2027, and beyond.
And I'll tell you, the analysts on this call, they weren't throwing softballs at all.
No, not at all.
They wanted really granular details on how ASML plans to survive what is basically an unprecedented tsunami of global demand, especially while they are, quite literally, physically running out of factory space to build the machines.
Okay, let's unpack this. Because while this starts as a high-level corporate financial Q&A, the stakes here dictate what kind of technology you, as the listener, will have access to 3 years from now.
Oh, absolutely. It affects everyone.
So we need to look at this massive demand spike, the rollout of these mind-bending new lithography techs, and how ASML is financially capitalizing on the panic.
It really is a panic out there in the industry.
It is. Let's start with the sheer scale of what ASML is trying to physically output. They are planning a 30% capacity increase. Like, they are actively investigating the production of 110 EUV tools by the year 2028.
Which is a massive jump.
Yeah, and the math laid out in the call implies they're targeting about 85 of these machines just for next year.
What's fascinating here is they are building this infrastructure without the safety net of formal paperwork.
Wait, what do you mean? Like, no contracts?
Right. The executives explicitly told the analysts they do not have purchase orders for those 110 systems yet.
That is wow.
I mean, in the traditional manufacturing world, you wait for the check to clear before you scale your factory, right?
Yeah, you'd think that'd be business 101.
But the demand signals ASML is getting from the world's biggest foundries are so overwhelmingly strong and honestly so desperate that ASML is preemptively rolling up its sleeves. They're spending the capital to prepare their supply chain anyway because they just know the orders are coming.
I have to push back on the actual physical logistics of this, though, because, we are talking about EUV machines.
Oh, they're behemoths.
Right. These things are the size of a city bus. They require, like 3 747s just to ship a single unit.
Yep, something like that.
And they are arguably the most complex pieces of hardware humanity has ever engineered. So how do you just magically build 30% more of them in a single year? Or are they just cramming more engineers shoulder to shoulder on the assembly line?
No. The operational gymnastics they're performing right now are extreme because space is their ultimate enemy.
Space in their own factories, you mean?
Exactly. ASML is breaking ground on a massive new campus this year. But realistically, pouring concrete and building out hyper clean rooms, that takes years. That new facility won't contribute a single machine to their output until well after 2028.
So they are trapped in their current footprint for the next 4 years while demand spikes 30%.
Yeah, they have to squeeze blood from a stone. They are literally evicting their own R&D teams from manufacturing cabins.
Wait, seriously? Just kicking them out?
Yes. They're moving prototype machines into storage just to make room for active production lines.
That sounds chaotic.
It's intense. But the real gain comes from relentlessly driving down cycle times. They are breaking down the assembly of these machines to the minute.
Oh, like hyper-optimizing the workflow.
Exactly. Finding ways to overlap testing phases, optimizing the flow of parts, so that a machine spends less time sitting on the factory floor before it's boxed up and shipped. It's really a masterclass in spatial optimization.
So you optimize every square inch of your factory and you squeeze every wasted minute out of your cycle time. But eventually, you hit a hard wall. The laws of physics dictate you can only build so many buses in a garage, right?
Right, you can't cheat physical dimensions.
So at that point, the only way to keep growing your overall output is to make the machines themselves fundamentally better.
And that is the hidden metric that completely shifts the narrative here.
How so?
Well, when ASML announces they are shipping 30% more physical units, the market just naturally assumes, okay, a 30% increase in chip-making capacity. But ASML is actually delivering about 45% more wafer capacity to their customers.
Wait, if they're delivering 45% more capacity with only 30% more machines, how does that math actually work? Are they swapping out older models?
Yes, they are swapping out older D's models, the 3600D, for these vastly newer E and F models.
But wait, aren't they just cannibalizing their own sales then? Like, why would a fab manager sign off on a massive purchase order for a D model today if they know it's going to be obsolete tomorrow?
It comes down to pure, unadulterated desperation for immediate capacity.
Ah, they just need it now.
Right. A foundry might know the E model is coming next year, but they have customer contracts demanding silicon right now.
I see.
They literally cannot afford to lose a year of market share waiting for the latest model. So they buy the older D model today just to keep the lights on, knowing full well the technology is about to jump forward.
And that jump is pretty significant, right?
It is. Moving into next year, ASML is shifting its production almost entirely to the 3800E and the upcoming 3800F models.
Here's where it gets really interesting because, well, the standard analogy is that it's like a shipping company replacing a fleet of cargo vans with high-speed bullet trains.
Right, I like that analogy.
Yeah, like you only have 30% more vehicles, but because they are radically faster, you move 45% more cargo.
Exactly.
But with lithography, it's not just about speed. It's like replacing those cargo vans with bullet trains, but with a catch. Those bullet trains also have to be able to thread a microscopic needle while moving at 200 miles per hour.
Yeah, that's a perfect way to put it.
These machines aren't just moving wafers faster, they are maintaining sub-nanometer precision at an industrial scale.
The mechanical precision required to increase throughput without degrading the print quality is just staggering. I mean, the E and F models fire the laser faster, they move the wafer stage quicker, and they align the optics more rapidly.
So they just churn out more chips in the same amount of time.
Exactly. They simply print more wafers per hour at the exact same, or even better, resolution. But here is the critical part of ASML's strategy. It's not just about selling the new bullet trains.
What else is there?
Well, the executives describe this as an and strategy. Because their customers, the chip makers like TSMC and Intel, they are just as physically constrained as ASML is.
Oh, right. They can't just throw up a new multi-billion-dollar clean room in a weekend. They're totally out of floor space, too.
Exactly. Which means the customers are aggressively demanding brand new, ultra-fast tools like the F model, which, by the way, aligns with printing the upcoming 1.4 nanometer chip nodes.
Okay.
But simultaneously, they're pouring capital into massive upgrade packages for the machines they already own.
Wait, they upgrade the ones already installed?
Yes. ASML noted that their installed base business, so upgrading existing tools out in the field, is expected to grow by over 30%.
That's a huge jump for just upgrades.
It is. A foundry will literally pay ASML to come in, swap out internal modules, upgrade the software, and replace components on a machine already sitting on their floor.
Just to squeeze out a little more performance.
Right, just to
Yeah.
bring an extra, say, 10% of wafer output from that specific square meter of cleanroom space.
So ASML is essentially selling them virtual real estate.
Basically, yes.
But let's look at the leverage this gives ASML, because if they are delivering 45% more manufacturing capacity, plus these highly lucrative installed base upgrades, that immense value has to translate into serious pricing power for them, right?
Absolutely. The ASML executives call it value-based pricing.
Value-based pricing, what does that actually look like in practice?
Well, historically, when ASML improves something like overlay, which is the machine's ability to perfectly align a new layer of circuitry on top of the previous layer without a single nanometer of deviation.
Right, precision stuff.
Yeah. In the past, they often gave that economic benefit to the customer for free, mostly just charging them for the raw speed increases.
Oh, really? Just throwing in the precision for free.
Pretty much. But in today's constrained environment, ASML is actively changing the conversation. They are demanding to be compensated for the full spectrum of value they provide.
Makes sense if everyone is desperate.
Exactly, which naturally leads to incredibly strong average selling prices, or ASPs.
Which totally makes sense for the systems currently printing chips at scale. But I want to pivot a little bit to the friction point in the Q&A regarding their absolute bleeding edge tech, the high NA system.
Yeah, yes, high NA.
We know the current tech, which is low NA, is selling incredibly well. But analysts on the call pointed out that customers are pushing back, basically saying high NA is just too expensive.
They're definitely feeling this sticker shock.
Right. So if low N is getting these massive speed upgrades and delivering so much value, why would a customer pay an exorbitant premium for high NA? Like, will ASML have to drop the price of their current tools to artificially force customers onto the new platform?
If we connect this to the bigger picture, it really comes down to the brutal economics of multi-patterning versus single patterning.
Okay, lay that out for us.
Where right now, to print the most advanced chips, foundries using low NA machines have to use what's called multi-patterning.
Which means printing the same thing multiple times.
Exactly. It means they run the same wafer through the machine 2, 3, or even 4 times just to create a single incredibly dense layer of circuitry.
That sounds terribly inefficient.
It takes forever. And worse, the chance of a microscopic defect ruining the entire chip skyrockets with every single pass.
Because it has to line up perfectly every time.
Right. But high NA fundamentally changes the angle the light hits the wafer, so it allows them to print those impossibly thin lines in a single pass.
Oh, wow. Okay, so high NA should be vastly cheaper to run in the long term then. Why all the customer complaints about price?
Because high NA only beats the cost effectiveness of low NA once the high NA platform reaches full, flawless operational maturity.
And I'm guessing it's not there yet.
Right now, the machine is still in its infancy. It's very expensive to buy, it's incredibly complex to integrate into a fab, and the whole ecosystem, like the photoresists and masks around it, is still stabilizing.
Got it.
ASML is working relentlessly to bring high NA to the same level of plug-and-play maturity that low NA currently enjoys.
But are they actually hitting that maturity? Because, promises don't print chips.
No, they don't. But the executives highlighted a very specific market signal to address this. They pointed to a recent press release from Intel showing that high NA is currently qualifying on actual product wafers.
Wait, actual product wafers, not just test runs?
Exactly. Not test wafers, but real silicon meant for the market.
Oh, that's a big deal.
It is. It tells the rest of the industry that the maturity of the platform is arriving, and that the cost crossover point, where high NA becomes economically undeniable, is rapidly approaching.
Wow. And you can't just hedge your bets by mixing and matching the supply chains either.
No, definitely not.
Because one of the most revealing moments in the transcript was about the actual optics inside these machines. The hyper-precise mirrors manufactured by Zeiss in Germany.
Oh, the Zeiss mirrors. The engineering on those is almost unbelievable.
Right. I mean, these mirrors have to be polished so perfectly that if they were the size of the Earth, the tallest mountain would be like a millimeter high.
It's hard to even wrap your head around that level of smoothness.
It really is. And an analyst basically asked on the call, hey, if low NA is in such high demand right now, can you just use the high NA manufacturing equipment at Zeiss to churn out more low NA mirrors?
Yeah, they wanted to know if they could cannibalize the future supply chain for present demand.
Exactly. And the answer?
The answer from management was a definitive no.
Really? Why not?
The supply chains are entirely non-fungible. You literally cannot use the Zeiss tooling designed for high NA optics to polish or produce low NA optics.
So they're completely separate systems.
Completely. The physics of the lenses, the manufacturing processes, even the physical cradles holding the glass, they are fundamentally distinct from one another.
So they are effectively running two completely parallel, highly complex supply chains at the exact same time. Like, they aren't sacrificing the future of high NA just to appease the current demand for low NA.
Right. It's a massive capital commitment. They have to build out the high NA supply chain based on where they think the market will be in 5 years, while simultaneously redlining the low NA supply chain for where the market is today.
So ASML is optimizing every millimeter of factory space, they're dictating value-based pricing, and they're managing these crazy bifurcated supply chains.
Yep, all at once.
Which really begs the question, who right now has the desperate need and the exceptionally deep pockets to actually pay for all of this? I mean, we always think of logic chips, the brains of our computers, as the main driver, but that isn't the whole story here, is it?
No, it's not. The logic market is obviously massive, but the explosive growth right now is actually in the memory market.
Memory. Really?
Yeah, the ASML executives casually dropped a staggering statistic. They are expecting 75% growth in memory demand in 2026.
75% growth in a single year.
Yep.
For heavy industrial machinery, that is a tidal wave. What exactly is driving that kind of panic buying in the memory sector?
Well, they described it as a perfect storm compounding on itself. So first you have raw volume increases driven by high bandwidth memory, or HBM, and standard DDR memory for AI servers.
Okay, AI needs memory. That makes sense.
Right, but HBM isn't just a traditional flat silicon chip. It's physically constructed by stacking layers of memory on top of each other, kind of like a skyscraper.
Oh, I see.
And then they punch microscopic holes, called through-silicon vias, to connect them all. Because you are physically building a skyscraper instead of a single-story house, you inherently have to print vastly more layers.
So the silicon simply spends exponentially more time sitting inside an ASML machine.
Exactly. It eats up machine time.
So AI needs more memory, and that memory is structurally thicker, which requires more machine time. But I remember there was a second factor they mentioned regarding the actual architecture of the memory nodes.
Yes, it's an increase in what they call litho intensity.
Litho intensity, what does that mean?
As memory manufacturers transition to their most advanced nodes, specifically things like the 1C and 1B architectures, the circuits are getting so incredibly microscopic that they can no longer rely on older, cheaper lithography.
Ah, they hit the wall on the old tech.
Right. They are being forced to use EUV machines for significantly more layers within the chip itself. So you have this global market demanding millions more memory chips. They are stacking those chips higher. And every single layer of that stack requires the most expensive, time-consuming lithography in the world.
Wow. Well, that perfectly explains why customers are beating down ASML's door right now.
It's a perfect storm.
But how does this translate to ASML's actual financial health? Because they are selling more, obviously, but running parallel supply chains and hyper-optimizing factories isn't cheap. What does the bottom line actually look like when you process this perfect storm?
The financial trajectory they laid out is incredibly robust. They broke down 4 specific drivers that will push their gross margins to a targeted exit rate of between 56 and 58% by the fourth quarter of 2026.
Okay, breaking those down really shows how the physics we just discussed translates into actual dollars. So what's the first driver?
The first one is the EUV product mix. As we discussed earlier, they are sunsetting the older D models and shifting entirely to those highly productive E and F models.
The bullet trains.
Right. And because they are applying value-based pricing to that higher productivity, those new machines naturally command significantly higher margins.
Okay, so better technology yields better margins. Simple enough. Second driver.
The second is a concentrated volume of immersion tools.
Those are the workhorse machines, right? Just a step below EUV.
Exactly. And a huge volume of those are slated for the second half of the year. They purposefully orchestrated a softer start to the year with their supplier, Zeiss, just to prepare the supply chain.
Whoa, I see.
Which means a highly profitable wave of immersion volume will hit their books all at once in the back half of the calendar.
Okay, so a backloaded year for their workhorse machines. What's the third driver?
The massive surge in installed base upgrades.
The virtual real estate we talked about.
Yep. Remember, foundries can't build new clean rooms fast enough, so they are throwing money at ASML to upgrade their existing machines. Selling a software unlock or swapping a highly engineered component on a machine that's already sitting in a customer's fab carries incredibly high margins for ASML.
Because it requires almost zero new factory floor space on ASML's end to execute, right?
Exactly. It's very low overhead for them.
And the final margin driver.
Pure fixed cost coverage. When you relentlessly optimize your cycle times and you push 30% more volume through the exact same physical factory, your factory pays for itself much faster.
That makes total sense.
Yeah, every machine produced after you cover your baseline overhead is wildly profitable.
So what does this all mean for the overall scale of the company? Because the executives guided for top-line revenue growth of around 35%. If revenue jumps 35%, don't they have to aggressively bloat their own expenses? Like hiring thousands of new engineers, expanding administration just to keep up with the chaos?
This raises an important question, and honestly, the executive's answer to it was perhaps the most impressive financial flex of the entire Q&A session.
Really? What did they say?
Well, while the top line is projected to grow by 35%, their operating expenses, their OPEX, are implicitly growing by only about 6%.
Wait. They are growing revenue by 35%, but their operating expenses are essentially flat at just 6%.
Yes.
That is a massive decoupling. How is that physically possible when you are building the most complex hardware on Earth?
It comes down to incredible operating leverage and the maturity of their R&D. I mean, think about it. In the past decade, ASML had to hire literal armies of engineers to invent EUV from scratch.
Right, they had to figure out how to even make it work.
Exactly. They had to substantially increase headcount just to make the technology function at all. But today, EUV is a functioning reality. They stated very clearly that they believe they can execute their extremely aggressive innovation roadmap with the core R&D teams they already have in place right now.
So they're just leveraging the massive investments they already made years ago.
Exactly. By shifting focus from sheer invention to optimization, and by utilizing those high-margin software upgrades we talked about, they are extracting significantly more financial output from their existing workforce without going on a massive, margin-crushing hiring spree.
It really is a masterclass in corporate balance. I mean, ASML is trapped in a finite physical footprint, yet they are squeezing out an incredible amount of efficiency.
They really are.
They are seamlessly transitioning an entire global industry to vastly superior machine models without even waiting for the paperwork to clear. They have positioned themselves perfectly to capture the immense panicked value generated by the AI memory boom. And they are doing all of it with a ruthless financial discipline that keeps their expenses flat while their revenue skyrockets.
They are solving for physical space, they are pushing the absolute boundaries of optical physics, and they are managing the complex economics of a bifurcated supply chain pretty much flawlessly.
And for you listening, it's crucial to remember that this high-level maneuvering isn't just, corporate trivia. It is the hidden physical engine driving the digital world you interact with every single day. When you prompt an AI to generate an image, or your phone seamlessly translates the language in real time, it feels like magic happening in the cloud. But that magic only happens because an engineer at ASML figured out how to shave 3 hours off a testing cycle to squeeze one more upgraded lithography machine out of a fully maxed out clean room in the Netherlands.
Yeah, the infinite scalability of our digital world is entirely reliant on these brutal microscopic victories won on the manufacturing floor.
Which leaves us with a final thought to ponder as we wrap up today's deep dive. Throughout all of these earnings transcripts, the underlying tension is physical space. Customers are paying premiums to upgrade old machines because they literally lack the clean room square footage for new ones.
Right, the space is just gone.
And entirely separate, massive supply chains are required for the next generation of optics because the literal polishing of the glass cannot be shared. So it makes you wonder, are we rapidly approaching a threshold where the true bottleneck for human technological progress is no longer our intellectual capacity to design a smarter, faster chip architecture?
That's a great question.
Right. Is the real limit going to be the sheer physical real estate on Earth and the raw, unbending physics of the supply chain required simply to house the machines that build our future? It seems the infinite horizon of the digital age is finally meeting the very finite reality of the physical world.